With us on our one-year anniversary, Alan Ruskin, my guest host for the hour, and joining us as well, Charles Dumas of Lombard Street Research. Charles, good to have you here on a difficult day for Europe. What is the significance of Dexia going down? D-E-X-I-A. Most Americans, we don't know that name. What did you think when you heard the news, France and Belgium to the rescue?
Well, as far as the rescue is concerned, there's no surprise there. And you know, when the tide goes down, I think that's when you find out who's been swimming naked. I think that's the general point here about Dexia. The broader issue, of course, is that the European banking system has a lot of difficult cases in it, sometimes because they're exposed to Greek and maybe Italian debt and various other forms of government debt. And those are serious problems. But of course, within Spain and Portugal, it's right. Huge overhang of business debt as well, which probably will not be sustainable.
Let's look at this chart to show the thermometer there, the trust out there, Euribor OIS, not Lehman-like, that's a spike up there, but you can see we are elevated on the right side of the chart as we were in 07, 08. Alan Ruskin, ask a question of Mr. Dumas, please.
Well, Mr. Dumas, Charles, I was wondering, do you think that, you know, now that most people anticipate a significant slowdown in Europe, that one will be forthcoming as early, for example, as the fourth quarter? Are we seeing a very, very sharp slowdown?
Well, in Germany, you've got significant growth of domestic capital spending still, which should sustain the fourth quarter. And, you know, where Germany goes, so does most of Benelux, Austria, Switzerland, Scandinavia. So that section of Europe should continue to grow into next year. The French are looking a bit flakier, but of course the Club Med situation is a disaster. So mostly it's, in the short run, it's the bifurcation that you've seen before. The big
so is this sorry to interrupt there, Charles. Is this a strong case for the ECB jumping in ahead of the game and actually cutting rates at this juncture in anticipation of the slowdown? And can they just dismiss the inflation data that we've just had of late?
Well, I haven't seen the core corresponding number, but the 2.5% inflation rate they had for August was matched by 1.5% for the number excluding energy and unprocessed food, I think it is. And frankly, unless that 1.5 has gone to 2%, there's no particular reason to hold the rates given the evident weakness in Europe. But we need to see what the core number is. As we know, the ECB does not actually pay, or pretends not to pay attention to the core data. So they may just stick it out for another month anyway, not least because I dare say Draghi wants to prove he's a tough guy.
Charles, in the time we've got left with you, I want to bring up this chart, which fascinates me. It's a Hungarian forint versus the euro, something, folks, we never look at. This is a big deal in Europe because of mortgages in Hungary, but you can see the line moving up on the right side is a very, very weak Hungarian forint. Charles Dumas, Hungary has a luxury of their own currency. This is the luxury these troubled nations don't have, isn't it?
Yes, it is. And in the Hungarian case, of course, you're probably going to get some write-offs, and there will have to be major write-offs in the Club Med countries down in southern Europe. But I would be reasonably prepared to bet that Greece, at least, and probably others will have their own currencies within 18 months.
Charles, let me ask you this, Alan. As you saw that chart of the Hungarian forint, I mean, as you and I were talking about the future of the euro, we still come back to this unique model of one currency for X number of nations, don't we?
Absolutely, and the difficulties are mostly revolve around the need for internal devaluation, and the scale of internal devaluation looks very, very large by almost any metric. You could see countries like Greece needing to effectively effect a devaluation, an internal devaluation of, say, maybe 40% to recoup
40
as much as that.
Well, Charles, last question to you. What are you going to be looking for through the rest of the week in Europe?
Rest of the week, I'm not so sure, but what I'm looking at the moment is that the Greek announcement that their deficit's going to be 8.5% rather than 7.5% of GDP is talking through the top of their heads, because the January to August numbers are up by 1/5 from a year ago, and the year ago total was 10.5% of GDP. So Greece is going to get worse, and the deficit will get worse the more they deflate the economy. They're just driving head first, full speed into a brick wall, and soon they're going to have to stop.
Very good. Charles Dumas, thank you so much. Lombard Street Research. And Alan, thank you so much for coming by.